Welcome to Indianomics. The bank Nifty has moved from being a laggard of the markets last year to the leader in 2025. Watch these numbers. The Nifty rose by 8.8% in calendar 2024, whereas the Bank Nifty rose only 5.5%. But in 2025, so far, in the first 100 days, the Nifty has risen only 2.7%, but the Bank Nifty has rallied 8.6%. Now, the complaints last year were India's old banking model is gone. People are no longer saving via bank fixed deposits, but they're saving via mutual funds. Banks have only short tenure money now and can no longer finance India's capex. Secondly, we were told banks will have to compete very hard for deposits, and hence they won't be as profitable as they used to be. And then there were, of course, short-term problems last year in terms of very tight liquidity, euphoria in unsecured loans and in MFIs, and all that hurt their profits. But then now, has Indian banking turned the corner? Come 2025, the narrative has changed. The Reserve Bank has cut the CRR, the new governor has ensured bucket loads of liquidity that has taken the interbank market to a surplus. Risk weights on NBFC loans to NBFCs have been cut, and liquidity coverage, or the amount of money that has to be kept in low-yielding government bonds, has also been cut this week. All of which has led bank stocks to stage a smart comeback. The question we are asking today is, are banks back to the glorious days of pre-2013 or even pre-2020, when we had 20% credit growth and 4% margins? Or is the current positivity only a relief from last year's very tight position? In other words, are the best days of Indian banking well and truly over? Or is the current rally of the last 2 months signaling the start of another glorious period? For these questions, I have with me an elite panel. I have with me Dinesh Khara, the former chairman of State Bank of India, Suresh Ganapathy, Managing Director and Head of Financial Services Research at Macquarie Capital. We also have with us Ashish Gupta, the Chief Investment Officer, CIO at Axis AMC, all banking experts, of course. Gentlemen, thank you very much indeed for your time. Mr. Khara, thank you in particular. Want to ask you first, as the person who has been there, done that, what is the sense you are getting? Can these loads and loads of liquidity still solve the structural problem that banks are no longer going to get easy float?
Well, I think, Latha, when it comes to the RBI step which have been taken in terms of providing liquidity, is certainly going to help in terms of ensuring that the loan rates come down, because otherwise the policy rates reduction would not have got transmitted into the loan rate reduction. Because typically speaking, the last year the banking system has seen that there was a huge challenge in terms of the liquidity. And I think as far as the structural readjustment is concerned, that has actually happened. And going forward, whether at what pace the banks can grow, to my mind, it's a function of the real economic growth. And plus, maybe, we have seen that in the real terms, the GDP growth has been around 10%, loan growth has been around 12%. And now whatever is being talked about by IMF also, they are actually talking about a little lower growth in terms of the GDP. And I think in terms of nominal terms, it would be somewhere around the same 10% or so. And if at all that being so, I think the banking system can very well grow somewhere in the range of about 12 to 15%, depending upon the capability of each of the bank to garner the deposit. The second question is that, the second aspect which I would like to highlight is that effective from 1st of April 26, this LCR reduction which has happened, it will actually release some further liquidity also. And overall, it is expected that it will further give a jump to the growth as far as the banking credit is concerned, to the extent of about 1.5 to about 2%. The third piece is relating to the co-lending. So this will also eventually help in terms of ensuring that the whole ecosystem is very well greased, and they can underwrite and pass on to those who have got the ability to absorb in the balance sheet.
Okay.
So I think these are the kind of things which will probably help in terms of pushing the growth.
Ashish, what is your sense? The question I'm asking is, the days of float seem to be over. Even government is not keeping the float. Even that is just in time spent. And so are savers like you and me. My father kept in FDs. I am not, and I will not, maybe even when I retire. So is that slack over for the banking system, and therefore the best days over?
So, Latha, if you recall, I think sometime last year on your show, we had discussed the fact that households are investing in mutual funds actually does not reduce the deposits in the system, right? It changes the nature of the deposit. So, you're right, from potentially money coming as float income or savings account, money will come as a fixed deposit account, money will come rather than a retail deposit, it will come as a wholesale deposit. And the nature of deposit changes, but the aggregate deposit growth in the system does not change.
No,
right?
yeah,
And
if I may just interrupt, you got it right.
yes,
What I'm trying to say is amount of money in the banking system obviously remains the same.
sure.
But
Yeah.
I think Rajeshwar Rao, the deputy governor, gave some data in one of his recent speeches that total amount of term deposits have fallen from about 66% of total deposits to about 60%. So the tenure of money is clearly going down. Won't
Sure.
that hurt margins?
Yes, yes. And I think it was a bigger problem when the runoff rate on LCR on wholesale deposits was very high, right? So I think what has been announced last week is very, very important. When the runoff rate on the wholesale deposit has come down, and wholesale deposits therefore also become part of lendable resources of banks. So it's not just retail deposit that they have to rely on for lending. The fact that wholesale deposits can also be used for lending, given the reduction in the runoff rate in LCR, I think is a very important change. Of course, this does not do anything in terms of the cost of funds. So, to the fact that the float deposits will be lower, the cost of deposits is going to be higher than maybe what banks have enjoyed historically. But that is something that potentially they can build into the pricing or will have potentially some impact on the margins. Right, but there are multiple levers on margins. What is the kind of loan mix you have? Secondly, what is happening on the deposit rate front, etc. So you have seen already several banks reducing their interest rate that they offer on savings deposit.
Suresh, to wind up this, is there a structural story in terms of banks being hit or no?
Yep. The advantage of speaking after two stalwarts like Mr. Khara and Ashish is that my job becomes much more easier to answer some of your questions. But let me try to put this in two contexts, right? One, to explain why the banking stocks have done well recently, and try to put it in the near-term context, and of course also try to address the structural story. So specifically taking points from Mr. Khara as well as Ashish is the fact that the monetary policy transmission has become easier because banks now have more liquidity with them, right? The fear in the market was that when we were going to go through a downward rate cycle, the repo rate linked loans will adjust downwards.
Yes.
But because there is a heavy competition for deposits and liquidity was continuously being tight, what could have happened here is that you will land up having losing margins because of the fact that your loan yields are immediately reset downwards because they're linked to repo rate, but you were not in a position to cut the deposit rates. Now, what has actually changed in the last 2-3 months here is because of the tremendous change in the liquidity stance, what's happened with the LCR rules. Effectively, the banks have become even more confident and they've gone ahead and cut the deposit rates, right? You've already seen special deposit schemes by HDFC Bank being cut by 35-40 basis points, which is quite a substantial amount. And even savings deposit rates have been cut by 25 basis points. So what this exactly means is what you are going to lose on margins this financial year, you're going to actually gain on margins the next financial year because of lag repricing of deposits. The second part, as far as structural growth drivers and stuff is concerned, look, Latha, let's be honest. I don't think at least for the foreseeable future, banks in India are going to grow at 20%. Now, there is a demand issue, there is a supply side issue. Demand in the sense that when we were growing at 20% in 2006 7, it was retail which is driving the growth. Then, post that, it was infrastructure and corporate capex cycle which is driving the growth. Gone are those days where you're going to see a 30% growth in personal loans and unsecured loans, or for that matter, mortgage loans. And gone are those days where you're going to see 20-25% growth in infrastructure loans or capex related loans, right? So, from a demand angle, there is an issue with respect to growth. So, we should be happy even if the outcomes are 14 to 15%. The supply side, look, I think all said and done, for every 100 rupees of deposits that you mobilize, unfortunately, 30 gets taken away, right? I mean, though the statutory appropriations will be 22%, I mean, you have to keep a little bit excess SLR to meet the LCR requirements and stuff, right? So roughly it comes out to be 20 to 30 bucks. Structurally, for India to gain greater degree of ability to mobilize and deploy, you need the fiscal deficit to be brought down. You need the government borrowing requirements to be brought down. You need the statutory requirements to be brought down.
But I'm still striking at a smaller point, and after that, I'll go off to the other question. Mr. Khara, you have seen the days when you were having float. Now it is, I think the average tenure of deposits in banks is way lower than 1 year now. Would your sense be that, we have to reconcile ourselves to a slightly lower margin than before? Banks will never be attractive as long as the tax laws don't favor you. Long-term capital gains for equities is 10%. For, fixed income, FD, it is your income slab, probably 33% for most of the savers. As long as you have the disadvantage, the margins are not going to be what they were previously. Is that a fair assumption?
Well, Latha, I think when it comes to the cost of deposit, that is something which you have seen that it has gone up last year also. And even prior to that also, it has been on the upward trajectory. But, when it comes to the kind of action which we have seen in the recent past, is essentially, I would say that it is an effort on the part of the banks to ensure that their names are protected. That is this is a very clear message, because, when the deposit continues to be, still there's the banks are clamoring for more and more deposit, but still we have seen that there's a cut in the interest rate as far as the deposits are concerned. So that is something which we have seen. So now what you are saying is that, whether, the cost is something which is a reality, which perhaps they will try to reduce something, but how much they will have to probably wait and watch, because all said and done, deposit is a franchising. And actually, when it comes to the savers' interest, that cannot be ignored, because unless and until there is a basic fuel, unless and until savers are taken care of, there will be a challenge in terms of mobilizing deposit.
Let me take a break on that point. Do banks now, to protect their margins, have to go aggressively after cutting their costs, for cutting their operational costs? Because interest costs, more or less, their back is to the wall in terms of the float money going away. That question after the break to my guests. Welcome back to the special Indianomics, where we are discussing the fortunes of the banking sector. Are the recent improvements in liquidity and lower liquidity coverage ratio rules only a palliative, or are banks likely to return to their glorious period of nearly high teens growth, 20% growth and 4% margins? I've been speaking with Dinesh Khara, former chairman of State Bank of India, Suresh Ganapathy, the head of financial services research at Macquarie Capital, and Ashish Gupta, the CIO, Axis Mutual Fund. Gentlemen, thank you very much for waiting on. Ashish, let me restart this question about banking stocks when you analyze it as an analyst and an investor now. Do you think banks have to aggressively cut costs, the point that Mr. Khara was making now, because the interest rate maneuverability is less?
No, definitely. I think longer term profitability, value enhancement really comes in a competitive market on basis of your cost and operating efficiencies. So I think banks will do well if they can really build on the scale and bring down costs. I think the big challenge in terms of cutting costs is going to be that a larger and larger proportion of costs is going towards technology. And the ask on technology that banks have coming on account of A, their large networks, B, the real-time payment system that are being offered free to all depositors, and of course, the increasing compliance, PMLA burdens means that they have to continue to invest more in technology. And of course, all of us know the uh, advancements in technology that is happening. All banks, I'm sure, are working on various AI projects. So in this context, for them to be able to scale back on technology costs is going to be very challenging, right? I think the other large component, of course, that has historically been there has been the employee costs. Uh, uh, that probably, I think the growth rates there have already plateaued. But I think technology spend is something banks will have to keep the pedal pressed hard on. And I think what this will lead to is that there will be increasing differentiation between large bank and small banks. And clearly, scale will benefit the larger banks because uh, what you need to spend on technology systems is agnostic to the size of your balance sheet, right?
Okay.
In many ways. So I think the opportunity that will be there, in my view, for the larger banks to get some benefit of scale and moderate their cost ratios are probably going to be more meaningful compared to the smaller banks.
Mm.
But your question is completely valid that the driver of profitability and the differentiation in profitability will come as much as what banks are able to deliver on their OPEX ratios.
Okay. Well, you know, until now, Suresh will bear me out as well as Ashish. When we were looking at banks, we used to look at NIMs, we used to look at NPAs, we used to look at credit cost. But Suresh, now you have a new parameter. Your last two reports are reporting on how much is the technology spend and how much are employees being, what is the employee strength, plus or minus. So, do you think these will be the new parameters for you banking experts to judge banks altogether? We won't just be looking at NIMs and credit cost. We will start looking at tech spends and employee expenses.
Interestingly, if you look at the profitability of the banking system today, and we analysts, of course, give an overwhelming importance to ROA because leverage is a function of the amount of capital that you hold, and accordingly, the ROA will be different. But if you look at on an ROA basis, the banking system today actually lands up having the best ROA at an aggregate level seen in the last 20 years or so, rather the best ever ROA.
Okay.
Of course, I understand that is more coming below the PPOP line item, right? The provisioning levels have been at rock bottom levels, and that is what has been driving the ROA. And provisioning levels can be a bit more cyclical in nature.
Mm.
Having said that, let me try to deliberate a little bit more on the cost ratios. Look, I think the banks so far have, of course, done a reasonably decent job. If you look at the last couple of years, the balance sheet growth of HDFC and ICICI, they have had a decent balance sheet growth, but they managed to keep the cost income ratios flat, right? Of course, we would ideally want a reduction in the cost income ratios, and HDFC Bank has had a tall target of 40% going down to 30% over the course of next 10 years. But initially, the way this would work here is that while you are having efficiency gains flowing through because of usage of technology, the technology spend itself is keeping the cost ratios, or rather not resulting in the cost ratios coming down. And that's what I wrote in today's report itself, that if you look at HDFC and ICICI on an absolute level, the cost, the technological expenses that they've incurred has gone up 4 times in the last 5 years. Right, that's the scale of technological expenses that's been done. And if you look at some of the global banks with the best technology and stuff, their total OPEX technology expenses to OPEX is closer to about 18 to 20%, whereas in India, we are at 10%. So indeed, if we have to catch up to them, understand the business models are different, they're more into investment banking and equities and where the cost ratios could be higher. But nevertheless, even if I were to see 10% going down or going up to 15%, at least in the near term, you are investing for the future. It would not flow into your profitability numbers. You're just preparing for the future that eventually you do this, you reach a plateau, and then you will start seeing the benefits of some of those technological investments, resulting in eventually lower OPEX ratios and eventually higher ROA.
Yeah, we are all hoping that AI is going to bring that manna, but first it will be investing in it. You know, I last spoke to KV Kamath. He said credit costs need to come down to 2/1/4. Now, that may be an extreme statement, but do you see credit costs for banks going down even to 30% that HDFC is talking about?
You're talking about OPEX, not credit cost, Latha.
Okay.
OPEX has to come down to 1/4, not credit cost.
Yeah.
Credit cost is
Sorry.
Yeah.
I meant OPEX. Yeah. Sorry, I meant cost to income actually.
Yeah, cost to income. Yeah. I mean, that's a very tall aspiration. I mean, it's good to have that, but I don't think in the near term that is something which is achievable. Remember also that banks are growing, they are setting up. You will have, of course, infrastructure costs, which will still rise and stuff, right? So, I mean, not 1/4, that's too much of an expectation, I would say. But yes, marginal reduction, maybe an annual reduction of 100 basis points over a period of 5, 6 years itself would be a great outcome, I would say, Latha.
Okay, yeah, I agree because there are so many tech spends that are looming. Just a final rapid fire from all of you. Mr. Khara, do you think we go back to the golden days of pre-2013 or even pre-2020 in terms of credit growth and margins?
I would say that we will go forward.
Sir, rapid fire. Yes or no?
Yes, we will.
Okay.
With the economy growing, it is certainly happening. It is certainly possible.
Okay, Ashish?
So I think both in terms of credit costs and margins, we are already at a very high level. So I think the challenge in stock performance has not been that. I think challenge had been that loan growth for the banking system had been falling. And with prospects of loan growth looking better, I think that is what drives the positivity towards the banks. I think we are very happy with the margins and credit costs they are operating at.
Okay. Rapid fire is not working for me, but Suresh, last word in
No,
terms.
I mean, I just cannot go against Ashish on this aspect. He's spot on. I mean, look, I think the real challenge today, Latha, here compared to what you have been comparing with respect to 2013 is not ROA, right? ROA today, as I said, is the best seen in the system at an aggregate level over the course of last 10, 15, 20 years. The real challenge is how do you go back to 20% growth? And there are several bottlenecks against that. Of course, Mr. Khara is a banker and always an optimist, but there in taking a very practical view and the uncertain trumped world that we are living in, I think it's very difficult to argue for a growth greater than 13-14% next year.
No, I take your point, Suresh. We should not have credit growth of 20 and 25% when nominal GDP is only growing at 9 or 10%. That will lead to other problems. But my reference was not to credit growth. My reference was to profitability. Will banks have the same profit rate that they had in the past? I have my doubts on that, but thank you very much for igniting our thinking on those lines. Thank you very much for joining me in this very special edition of Indianomics.